This is a perfect segue because the second of the three parts here is financial forecasting and cash flow management. You brought up the rolling forecast.
Yep.
Let's get into that. Let's talk about the rolling and the benefits of that versus other models.
Yep.
Mason, you want to take that away for it?
I would say I want to preface that forecasting is certainly important. I think some people can get highly dependent upon the data itself. And I would say that there's just some common sense things here that I want to make sure, the folks really understand and that, hey, watch your costs, bill your customers as quickly as you possibly can. The faster you can bill them and get a bill out the door, the better. You want to measure your accounts receivable weekly and make it a part of the sales process that you emphasize the payment term expectations. If you can emphasize those four things, that will go a long way in regards to your cash flow management. But to get into the forecasting piece of it, that really what we recommend and we do with any of our clients, we do what's called 3-statement financial modeling, where really what it is we model 2 statements and then it produces the 3rd statement. So there's actually 3 financial statements: the income statement, the balance sheet, and the statement of cash flows. Many business owners are very familiar with the P&L or the income statement, but it's really important to also model the balance sheet. We're talking about several sales and marketing initiatives, but if you ramp up your sales, you might need new pieces of equipment. And on your balance sheet is where you're going to post that equipment and the financing related to that equipment and the cash that has to go out the door to pay for whatever that piece of equipment, or you may finance it with debt or whatever the case is. So what we do is that we model and forecast the income statement, the balance sheet, and the 2 effects of those things produce a statement of cash flows where we can determine, hey, this business is still flush with cash. It has plenty of liquidity. It'll meet its banking loan covenants, et cetera, under all these scenarios. And to your point, Aaron, and what I was talking about earlier, we can go about every month and dynamically model new scenarios that, hey, sales are ramping up. We need to consider a new piece of equipment. Well, we'll go into the model with our clients and we'll plug in that new piece of equipment, its cost, and potentially how we're going to finance it. And we'll make sure, hey, we're still going to meet our metrics and our KPIs for liquidity by the end of the year. Bank is going to be happy, et cetera. We're good to go. Let's, and decision made, let's run with it. So
Alex, we need Mason in there in some of these instances, to your point, Alex.
Yeah, no kidding.
Where we've proven the model, but they're not aware of their cash flow well enough to know they can now take advantage of that model and make more gross or net profit.
Yeah, exactly. So from a forecasting perspective, like what are you seeing? How do you advise your clients in terms of marketing and sales spend? Is it on a percentage of their revenue, or how do you help them determine what they should spend on marketing and sales? Because we get that question a lot, especially from startups or like earlier stage businesses that are kind of hitting this place where they're about to grow more quickly, right? How much should I spend? How do you frame that for them?
I think, especially for us, when we're working with several clients and we work with several different industries, I know that some can go by a rule of thumb in regards to, hey, percentage value, this is what you should be spending, et cetera. The nature and the reality of where the quality of accounting records are, especially in the size of businesses that we work with. So we specialize in working with businesses 5 to 50 million in revenue. You could have people that are in a sales function wearing multiple different hats. And so are you perfectly breaking down how much of their time and salary is spent in sales and coding that to your financial reports? Oftentimes it's not the case. Would we love that? Yes.
Probably not.
Yeah, we would love that. But, the reality is that that's going to take an investment in additional accounting resources to get that breakdown and to post that accurately, et cetera. And you have to weigh the cost benefit of that. I think what we do more often when we step into client situations is we evaluate, are the sales targets, are they reaching the sales targets that they desire? And if they aren't, then we look inside and we look in the financials and the potential budget and we identify, is there room for spend in additional marketing initiatives? That I know, Alex, like you and I, for example, worked on a client recently where, their sales was stunted. That one of the reasons, I wanted to bring you all in, that they had a decent sales year the year prior. And then as we began to forecast, they were giving me forecasts for it lesser than the previous year. And I said, this is not possible with increasing operating costs, et cetera. So let's figure out how to make some room in the budget for some sales and marketing initiatives. And this is the potential ROI, and this is what we need to be aiming at. And so I hate to personally put it at a perfect peg, like, hey, you need to be spending 20%. It's more so, are they reaching their sales targets or not? Are they seeing consistent growth? And if they're not, we've got to figure out a way to make room in that budget for some sales and marketing cost and spend.